Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Matt Bartolini, head of Spider America's research at State Street Global Advisors. We're talking about how the outcome of the presidential election may impact your investment portfolio. Matt, welcome. Thanks for joining us today.
Yeah, thanks for having me back.
So, we are now less than 3 weeks away from the presidential election, and recent polls, they suggest that former Vice President Biden has widened his lead over President Trump, and particularly since the first presidential debate and Trump's hospitalization for coronavirus infection. And we have seen that stocks have rallied in October. And is that because markets like certainty more than who actually wins the election? Because earlier investors were really worried about the rising possibility of a delayed or contested election result. And that was seen as one of the reasons for heightened volatility and turbulence that we saw in September.
Yeah, I think recently the poll numbers have improved for former Vice President Joe Biden. That has maybe potentially reduced some of the probability of, uncertain results on election night or contested results, if you will. But I think that's a little bit too early to say, the complete probability of a delayed election result is off the table. Estimates indicate that 64% of all votes will be cast by mail in this election. That's up 22% from the 2016 election. There are statewide differences on how the ballots will be collected and counted. The U.S. Postal Service warned 46 states and the District of Columbia that all ballots cast by mail may not arrive in time to be counted. Some estimates actually say it could take weeks to count all the votes. And if there is a drawn-out ballot count, that actually should have an impact on portfolios. We have seen this happen before. It's a sample size of one, but it's still nonetheless important to look at. So if we go back to 2000, in 2000, there was a Florida recount drama that lasted 36 days. In those 36 days, risk assets fell across the board. Small caps were down 7%, large caps down 5%, international stocks were down, as well as high yield. But not all stocks fell, though. High quality, low volatility stocks were positive and actually outperformed the S&P 500 by 6 and 8% respectively. Outside of stocks, gold was up 2%. Bonds were positive. Long-term treasuries rallied 6%. So given there is still a heightened chance, no matter which way the polls are going right now, of a delayed election result and potentially any lawsuits that may emerge. And we've already had some on the election mailing processes within this current cycle. Altogether, having an equity exposure tilted towards high quality, low volatility stocks, as well as having defensive allocations in your portfolio, like long-term treasuries or gold, may be beneficial if there is any delay. And I think the big thing to remember is that this is going to be more than just one state potentially holding up the election night results, because there's many states that are seeing an influx of voting by mail. So that this actually could draw out longer than the 36 days. I think investors need to be somewhat uniquely prepared for the potential outcome that on the night of November 3rd, we don't actually have a confirmed victor.
That's true. It's going to be an interesting October, November, probably December too. And as far as the lead is concerned, we should remember how wrong the pollsters and polls were in 2016. And anything can happen between now and the election. But at the same time, it is important to understand how each candidate's policies could impact your portfolio because they have very different views on a range of policy issues from climate change to healthcare and taxes. So let's start with taxes. So it is most people believe that a Biden win would result in higher taxes for corporations and wealthy individuals. So, what do investors need to know with that in mind?
Well, I think the first thing investors need to understand and know ahead of this the election results with respect to tax policies is that one, the views are diametrically opposed, but really the implementation of these policies is likely to be a result of what happens in the congressional elections. So the House of Representatives is has an 85% probability of being still maintained under Democratic control. With Republicans in the Senate, still a toss-up of whether or not they'd be able to retain control of the Senate. It's a close race through many swing states. If no matter who wins, if there is a split Congress, it is unlikely that either Trump's tax cut plan or Biden's tax hike plan goes through. So I think it really comes down to what happens at really the Senate, because in the House of Representatives, again, the 85% probability is sort of, quite high to say the least. But this doesn't mean that investors shouldn't be cognizant of potential implementation ideas when it comes to taxes, because for who knows, if there is a split Congress and Trump is able to secure a second term, perhaps tax cuts are a way of doing stimulus, particularly if the pandemic continues to rage on. So when we look at the policies they put forth and what may likely benefit what segments or sectors, for the Republican President Trump, lower taxes are expected to remain a focal point of his reelection. We've already seen some comments from Larry Kudlow and Treasury Secretary Steven Mnuchin about this. Lower taxes at the corporate and consumer level may spur consumption and economic growth and benefit firms with high effective tax rates. So if Trump was able to win a second term, high tax rate areas such as consumer staples, 29% effective tax rate in 2019, retail, 24% effective tax rate in 2019 may do well, as their earnings could be more positively impacted by paying less in taxes. Additionally, lower tax rates could spur consumption and be a benefit to certain consumer-focused markets, which of course retail is part of that. Conversely, under Biden, low effective tax segments would benefit if there's a increase in taxes, right? Because their earnings would be less adversely impacted, and that goes to real estate. Real estate, there's only about a 4% effective tax rate in 2019. Similarly, tax-exempt bonds, like high-yield municipal bonds, may be more attractive if there's higher tax rates, because that income would be tax-exempt.
So let's move on to trade now. So we know that President Trump had a more confrontational trade policy, particularly with China, and his administration, they imposed a number of tariffs on Chinese imports. Biden has said that he'll work with our allies. He will revisit the use of tariffs and also try to create a more united front with our allies to confront China. So how will these policies impact the various areas of the market?
Well, yeah, for trade, unlike taxes, which require that congressional approval, there are more sweeping powers within the White House when it does come to trade. For Biden, he is more of a globalist who likely repeal current tariffs, while Trump's administration will continue their America First policy, and again, will likely feature tariffs as a way to achieve their objectives. We saw this even recently in August with some tariffs on Canadian steel products. So if Biden wins, you have a repeal of some tariffs, probably more inclusion in trade partnerships. The negative price action we witnessed when tariffs were levied on Chinese equities back under the Trump administration, they may be reversed. Similarly, given the number of tariffs placed on European products and services, that region could see a boost in sentiment if Biden wins as well. So I think overall, a Biden victory would favor international exposures, just reducing that headline risk of trade uncertainty and the restricting of cash flows that may have on international companies that export their goods to us. Conversely, if Trump is able to win a second term, focusing on more domestic segments in the U.S. market that are less exposed to international supply chains may be advantageous. Mid and small cap firms roughly have about 20% of their revenue from overseas, and that's much lower than large cap, which tend to be in the 40% range. And then from a stylistic perspective, whether you're looking at large, mid, or small, value oriented exposures have a low amount of revenue from overseas as well, relative to growth. So really, that sort of domestically oriented exposure for a continued trade tariff implementation under a Trump administration, small cap value may be one area to take a look at.
Yeah, we have seen that small caps have done well in the recent weeks. I don't know whether because of this expectation for a blue wave. And as far as growth versus value is concerned, growth stocks have significantly outperformed value for this year, last year, probably the last decade. So probably value will come back. Value will come back sometime.
It's been a tough run for value. It's been a tough run for value.
Right. So we will see. So let's talk about climate and infrastructure. We've also seen that solar and clean energy stocks have done really well, and those ETFs too have done really well in recent weeks. Maybe the probability of a blue wave has boosted those stocks and ETFs because we know that Biden has pledged to spend $2 trillion to combat climate change and greater support for renewable energy. So talk a little bit about the impact of his policies on clean versus traditional energy and what would happen if President Trump is reelected.
Yeah, so within clean energy, there are secular underpinnings with respect to the evolution of our society moving to more renewable energy. We've seen this before the election. We've seen this before the pandemic, and it's, I think, been amplified post-pandemic, just how we've changed our different energy conservation and consumption habits. With all of us working remotely, our energy needs have definitely changed. But in 2020, we've generated more electricity from renewable power than from coal the first time on record. So irregardless of the outcome of the election, the path of more renewable forms of energy is going to continue to grow just based on the investments that have taken place so far, but also the cost savings associated with it, and also clearly the benefit to the broader world from a carbon emission perspective, environmental perspective. But when we take a look at the two candidates' policies in this place, Biden, with his plan to seek to achieve carbon neutrality within the U.S. energy sector by 2035, the call to install over 500,000 electric vehicle charging stations nationwide and shift more to electric vehicles and electric public transportation. Under Biden, clean energy will be supercharged. We have seen this within the recent few days. Price performance on a basket of clean energy stocks, like if we use our fund CNRG as a proxy for that, has moved in tandem with an increase in Biden's polling numbers. So the relative outperformance of CNRG relative to, say, the S&P 500, has moved in line with how the polls have manifested themselves over the last 2 to 3 weeks. And I think that's a little bit of positioning ahead of what is likely to be if the polls are correct, an administration that is pro renewables, even including having more regulation on natural resource production, as well as being more included in the Paris Climate Agreement. Conversely, under a Trump administration, the aspect of energy is more around deregulation, which oddly, the energy sector under the administration, because of the global supply dynamics, has been one of the worst performers. So some of the deregulation doesn't actually manifest itself into, say, stock price performance. I think rather for when we talk about clean energy, we're really talking about infrastructure spending and where would the stimulus go. Under a Biden policy, it would go towards renewable forms of energy and sustainable infrastructure, so smart homes, smart power grids, things along those lines. I think based on the infrastructure plans that we've seen under the current administration, it would likely more go to traditional means of infrastructure spending. So in our view, under a second term for Trump, if he's able to obtain that, it would go to natural resource producers, the ones that are able to assist in providing the commodities used in building the bridges, roads, and airports that we actually desperately do need. So I think, it's, again, sort of diametrically opposed views on the implementation of stimulus, not on the idea of some sort of infrastructure stimulus. With Biden favoring, clean energy stocks, where Trump would be more the camp of traditional industrials, like metals and mining companies.
I did notice the excellent performance by your clean energy ETF. It's the Spider S&P Kensho Clean Power ETF, ticker symbol CNRG, and it is really shining over the past 2-3 weeks, up almost 25% in the past 3 weeks. So that is definitely worth a look. Now let's talk about healthcare. So Biden is looking to expand Medicaid and Medicare, and he'll be protecting the Affordable Care Act. President Trump wants to dismantle ACA. So tell us how that is going to impact healthcare, the various sectors, industries within healthcare.
Yeah, so within healthcare, if we take sort of the Trump portfolio first, obviously it's going to depend on a Supreme Court vote. We're obviously going through a nomination process now, which could have an impact on that. So there's still a lot of headline risk associated with the broader healthcare sector as part of this election. I think under Trump, the severe headline risk of progressive healthcare reform, as well as really strict drug pricing on big pharma, is likely to lessen. Well, we have seen some policies out there around drug pricing. It hasn't been whole-scale sweeping changes. It's obviously been constructive, but it hasn't been some of the bigger changes that the Democrat ticket has, put forth. So some of that headline risk in healthcare may lessen. So broad-based healthcare firms may benefit just overall from that. With respect to the ACA being less powerful or being weakened further, if there is the ability to weaken it or to even repeal it outright, I think we just take a look at what happened when it was put in place back in March of 2010. Healthcare services companies fell by 10% over the subsequent 3 months. The inverse could occur if the ACA is completely removed. So I think that's something to keep an eye on, not just for the election, but of course for what we're seeing in the Supreme Court nomination proceedings that are going on currently. On the flip side, with Biden, we're seeing more healthcare policies put forth around fighting the COVID-19 and his COVID-19 response plans, which is, for more healthcare spending to combat, treat, and trace COVID-19. So I think firms focusing on pursuing those novel treatments as well as equipment and testing may benefit a bit more under a Biden administration. Given the left-tailed nature of the vaccine race, where winners and losers are likely to emerge, our feeling is that being appropriately diversified within biotech is ideal, in that if you're in a concentrated, market cap weighted portfolio, you're taking on far too much firm-specific risk. And we've seen in the last few days, a handful of companies have come out and had to halt their trials. And that's what we're referring to as, the left-tailed nature of this vaccine race. There are going to be winners and losers. And that's why, I think we've seen, within our strategies that are more equally weighted, that less concentration has been helpful, but you're still able to pick up the broader theme of healthcare spending, biotech firms, racing to a cure for novel treatments.
Yeah, I agree with you. Trying to predict a virus winner is not easy. So an ETF approach is much better. XBI is definitely worth a look. Now let's talk about technology and antitrust. Big technology companies have led the market rally this year and over the past decade as well. And in fact, this year they're responsible for most of the market gains.
Mm-hmm.
And recently we had a House antitrust report, which concluded that these companies are monopolies. So do you think big tech is going to face increased scrutiny if Biden wins, or if they are going to face increased scrutiny no matter who wins the election?
Well, I think if you take a step back, the Trump administration over the past few years has favored more deregulation of the tech sector, the rolling back of net neutrality, as well as some broadband privacy rules. And in Trump's first term, antitrust actions have primarily been centered on televised hearings of tech CEOs appearing before Congress. I think a second term may leave big tech alone, meaning minimal headline risk. And I think it is worth noting that large cap technology firms have had the best performance and profit growth versus any other sector under the Trump administration, rallying 156% and seeing annual sales climb from 221 billion to 330 billion. And I think, in my view, if President Trump is able to secure a second term, this will likely continue, and mega cap tech firms will, not have antitrust be a large concern of their daily operations. Like, conversely, Democrats overall are more likely to pursue antitrust regulation on mega cap tech conglomerates. We've already seen, as you mentioned, House Democrats propose a series of far-reaching antitrust reforms to curb the power of tech giants. And honestly, it's a bit harsher than anything we've seen come out of the current Department of Justice or anything that they're planning to do. And on the campaign trail during the primaries, back when we had a normally functioning campaign trail, Biden criticized the current antitrust process. And their party overall, from a Democratic perspective, it has a more stringent stance on antitrust. And I think overall that could hamper large tech-related firms. As a result, under Biden, there could be more room for smaller cap tech-related firms to prosper as larger mega cap firms deal with antitrust lawsuits. We just go back to an oral history of the Microsoft antitrust case from 1998. A well-connected antitrust lawyer who represented Netscape in the 90s said, "Because of antitrust endorsement, that is why we have Google. There is no other reason." If we were to have a similar antitrust event, in my opinion, a smaller entrepreneurial firm may make the same leap that Google did in the years after, while that behemoth Microsoft back in the 2000s was dealing with antitrust scrutiny. And I think that's why under Biden, innovative mid and small cap firms may be more attractive than large cap. And then also they're still able to benefit as a result of that societal sea change we're witnessing as a result of COVID-19 and how important technology is to our daily routines.
Could you talk a little bit about some of the implementation ideas for technology if investors, want to look at some other tech companies apart from big tech in case Biden wins?
Yeah, so I mean, within our suite, we have a whole lineup of thematic ETFs that scan regulatory filings to target firms innovating within a specific space. Like you mentioned, clean energy with CNRG, or SIMS with intelligent infrastructure. But the broad-based nature of innovation in our current economy is more aptly suited or provided, potentially provided by a fund like KOMP, the Spider S&P Kensho New Economies ETF comp. And that covers roughly 400 securities throughout the market cap spectrum of firms innovating within a wide variety of technologies, whether it be digital payments, smart homes, autonomous vehicles, clean power, clearly, nanotechnology, genetics, and the like. And I think, given its multi-cap focus, where it does have a sort of an equal weighted feel to it, where it's evenly dispersed across quintiles of market capitalization, it is broad-based but targeted on innovation. I think an area like that may warrant consideration in just in the environment overall, just given the transcendent nature of some of these thematic impacts from the COVID-19 pandemic. But also under a Biden administration, some of these firms are, they're not these mega cap firms. They are more entrepreneurial and may not have to deal with the antitrust headaches that some of the bigger mega cap firms may have to.
Those are some excellent ideas for positioning investor portfolios for the election outcome. Now let's switch gears a little bit and focus on some of the longer term trends that have been accelerated by this pandemic. We have seen increased digitization, probably 7-8 years worth of digitization has happened in the past 7-8 months. We have seen a boom in housing markets because of this migration from urban areas to suburbs because of work from anywhere trend, which may continue even after this crisis is over. So you published a note. There were some excellent investment ideas to benefit from these longer term trends. Please talk a little bit about that.
Yeah, so the trends we outlined in one of our quarterly pieces was around housing. We've seen an uptick in housing starts and new homes, and I think that's only going to continue based on some of the now real generational trends we've witnessed following the COVID-19 pandemic, where our housing formation is drastically changing, people moving more out of the cities. We've seen home prices rise. You also have extremely low mortgage rates, so it's going to be overall conducive for home builders. And we've seen home builder stocks rally significantly as a result of this. With uptick demand, they've been quite busy since the onset of the pandemic. I think that's only likely to continue. There's been other, sort of societal inflection points too. One of the other ones we highlighted was around transportation. With that last mile sort of trucking type of processes and the need for sort of contactless or autonomous type vehicles, smart transportation is one of the areas of the market that's seen performance really rally since the bottom of the market. So those are two areas that we called out of, two of many areas that are having some of their longer term trends be completely augmented and amplified in some respects as a result of the COVID-19 pandemic. And two of those are home builders and then smart transportation.
Yeah, XHB is a very interesting product. In addition to home builders, it has a lot of exposure to home improvement companies, home furnishing companies, and we know that we all are spending a lot of time at home, so everyone is trying to improve their home. So that is an ETF which may continue to do well. That's all we have time for today. Matt, thanks again for joining us.
Thank you very much.
Thanks for listening. If you want to learn more about these ETFs, please visit the ETF section of Sachs.com. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so you do not miss any episode. If you have any comments or questions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.